Welcome back to Wilson Weekly on the Money Mentor podcast, where data meets drama and the property market never sleeps, even if some of us are begging for it to. We've got rates holding, rents shifting, and auctions starting to ease as expected as we head into the Christmas break. And of course, we've got Doc here to translate the chaos into something we can all understand. Hello again, Doc. What do you have for us this week?
Yeah, g'day, Rachel. And as you said, we're just about all over it, are we not? It's been a big year. It's been a big spring. It's been a big December, even though we're 1 week into it. We've got one more show for the year, so look forward to that one. And we'll have also a year that was show coming through at some stage, so look out for that one. But one more week of activity. But this is the first week in December, and we are winding down. I guess all the buying and selling is just about being done, although there's still some good numbers coming through in the weekend auction market or the weekly auction markets. And of course, as we'll find out today, there's been a bit of action around with the Reserve Bank meeting in December, just a couple of days ago. So not unexpected result on hold, but we'll look into the tea leaves in terms of that particular result. So every week, Rachael and I bring you the Wilson Weekly with in conjunction with My Housing Market and the good folks at Infinity, and we're all about the current state and future prospects of your housing market. Clickbait free zone here. We're all about evidence-based insights into the housing market as in real time as we can get it, so you can make informed decisions. And we all want to make informed decisions if we are engaged in buying and selling in property, because it's a big ask for most of us, is it not, Rachael? So let's get going. It is the week ending Wednesday, December 10th, first full week of December. I can just about hear the bells on those reindeer. Can you not, Rachael? Imminent. Hope you've done your shopping, or you're going to be facing big crowds there in the next. You haven't done it. Oh well, get ready for the crush.
I know the property market's keeping me too busy.
Well, that's good, I guess. But it's been a busy year, and it's still been a busy last week, as we'll see. So interest rates. The November, that should be the December interest rate policy decision, of course. It looks like the holiday mood has got to me as well, but we'll scrub that one out for the update. But the December interest rate decision, November home rents, and that's going to be, there's some very interesting data there, Rachael. Are we starting to see a breakout in rents again? I think maybe we are. We've been sort of predicting that with these low vacancy rates we've had consistently for as long back as we can remember just about now, and maybe signs that those low vacancy rates are finally starting to push rents upwards. Not good news for tenants, but I guess it's good news for landlords out there. And as usual, the weekly auction results. And as you said, Rachael, certainly signs not unexpected of just our markets becoming a little tired as we're now within a week of the end of the season. So let's have a look. The RBA rate's steady again over December, 4 months in a row now with a steady rate, even though it sounds like, oh, well, everything's cool and everything's, just sort of as we expected. It's not really, because there has been a key change in a lot of the narrative behind interest rate decision. In fact, I guess my takeaway is it's becoming a lot less certain in terms of what the Reserve Bank is now expecting from the key drivers. And really, in a sense, the Reserve Bank's sort of having a bob each way in terms of what the prospects for interest rates are going forward, and for the main drivers, which of course is inflation and the labour market particularly. So I think we're in for a protracted period of steady rates, which is actually good news in a way, going forward, because it gives us a bit more certainty in terms of outcomes. But never say never, because we do have still a lot of potential volatility in those key drivers, not just local economic drivers, but also international economic drivers. So let's have a look what the Reserve Bank said. It left rates steady at 3.6%. As Rachael and I mentioned, that's now the same result for the past 4 months, 4 decisions. And this is what the Reserve Bank said, and this is a couple of snapshots from their commentary. The board's judgment is that some of the recent increase in underlying inflation was due to temporary factors. Well, really? Question mark. Those temporary factors are electricity prices. And yes, I guess it's temporary because prices have been pushed up as we said last time when we were speaking about inflation, as we ended the subsidies that the federal government generously gave us all, those $300 per year subsidies for our electricity bills per household. They came to an end in June this year. They were replaced by what you'd call subsidy light, which was half the benefits from the original subsidy. But of course, when we moved into subsidy light, we no longer had the benefit of the full subsidy, so we had to pay more for electricity. And as we saw with the monthly inflation rate that was released, recently, and of course that was for October. It increased by 37%. Yes, 37% increase in electricity prices over the year. And of course, people are there going, well, yeah, I know, you're not telling me anything, mate. Seriously. I look at that electricity bill and I think, gee whiz, what am I going to have to save to counter these rising electricity prices? So yes, it's temporary because, the subsidy light's going to finish at the end of this year. So it's going to finish this month. Now, whether the government replaces that with another subsidy is problematic because this is obviously an issue for them because people aren't going to be terribly happy with higher electricity prices. But the point is that going forward, when we see the annual results, once we get past a year beyond this year, December, we're not going to see that comparison with the subsidy data, right? Or 6 months beyond. We're going to, have the same old, whatever the price of electricity is without countering either a subsidy or the lack of a subsidy. So that should start to ease inflation. So I guess, yes, it's temporary, but, the point is that prices would have risen to that point and there's no reductions coming through here. It's just that we won't see electricity rising by 37% every year, month by month. It'll be not rising as much, but it'll still be high. And the point to all that is people have to find a way to cover these increased electricity costs particularly. And it's sort of the organic cost of electricity that's still rising, irrespective of the support we've had from those subsidies. Underlying electricity prices are still rising because the transition from the carbon economy to the renewables, a renewable economy, is taking longer and costing more than originally hoped. So we are going to continue to see higher organic, if you know what I mean, underlying electricity prices. Now, the point to all that is we need to sort of talk about temporary factors. Yeah, we can understand that. But, I don't know, what are you paying for a cup of coffee at the moment, Rachel?
Oh, it's still $7 or $8.
Yeah, I mean, hello.
Yeah.
Gosh. And I mean, I think it's like there's a thing called the Big Mac Index, which is used as a sort of a comparison of the cost of goods between nations. Now, this isn't a comparison of the cost of goods, but this is sort of telling us on the ground, because Australians love their coffee, Rachel. I know you love your coffee. I love my coffee. Got to have 2 a day or I can't function. So I think that's a good measure of just sort of the way prices are moving. And I think also there's a lot of electricity used, is there not, in brewing a cup of coffee, the baristas? Yep. I mean, that's right, frothing and all that sort of stuff. It's taken a little bit of juice to do that. So obviously they need to cover their costs, just as we need to cover our increased coffee costs. So what that means is we start asking the boss for more wages, for higher wages. So the boss then has to put up his prices or her prices to cover the cost of higher wages. You see where I'm getting at here? So this sort of starts to get the ball rolling for underlying inflation down the track. So even though we might get some sort of relief because of the moving through the subsidy period from those huge increases in electricity that we've had over the past 6 months, it's not necessarily going to mean relief from inflation going forward. And the other problem we have is, we've done pretty well with oil prices because they've continued to fall. But I don't know, do you buy a lot of petrol there, Rachel? I mean, I don't know. Petrol prices are still pretty high. I mean, the pump price is still over $2 in most capital cities. and yet we've had this big reduction in the price of oil, and yet we're still paying higher petrol prices per litre than you'd expect with a lower international oil price. So you see what I'm getting at here? I think we're still on a bit of a, hoping and a wishing and a praying from the Reserve Bank that inflation continues to be within their target range, which it's not at the moment. They said that some of the recent increases in underlying inflation was due to temporary factors. Okay, we understand that. But there is uncertainty about how much signal data from the monthly CPI. Now, we've now moved into this monthly CPI. We discussed this a couple of weeks ago when we got the latest data. It's a completely different measure. So in a way, you're blaming the umpire here. It's the ABS, who gives you the measure, saying, oh, well, it's not our fault, blame them. And there was some changes in the monthly data set when it went to what they would call the full monthly data set. I'm not sure why that had to be so different, but it was, and it did show higher inflation. But the Reserve Bank saying, oh, well, don't blame us, blame the ABS, or, because they've got a different measuring process. But it does say that nevertheless, the data does suggest that there is more broadly based pickup in inflation, part of which may be persistent and will bear close monitoring. So it's like, oh, it's only temporary, it's about the measurement, right? Don't worry. And then it says, yeah, but it might be persistent and it might bear monitoring. Like, yeah, really? Is this not a bob each way sort of thing about what the outlook is? So, okay, I guess, the Reserve Bank's in a sort of tough position in a way because its predictions haven't been certainly as, as accurate as perhaps they'd like it to be in terms of the inflation rate. And, they're now saying that they hope to get inflation back within the target range in 2027. Hello, what year is it now? It's 2025. That's 2 years away. So
what do we all do in 2026?
Yeah, but what can happen in the next 2 years, for goodness sake? It's only 9 months since we had Trump start his tariff, roller coaster ride. And that was supposed to be the end of the world. Just look back at, tariff implications. The stock markets crashed when it happened. Of course, nothing's happened. Nothing has happened, So, but we had, the knee-jerk clickbait reaction when it was announced. So I'm just saying these things can come along out of left field, bang, 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 and then all bets are off. And of course, it's difficult for the Reserve Bank to counter what can be, unpredictable outcomes from left field in terms of their outlook. So, and as I said, they might say, oh, well, by the middle of 2027, we should be back to normal in terms of, say, electricity prices. But what would have happened perhaps in the interim in terms of oil prices? Just an example. And the latest inflation data, and we'll segue this into the rent report, which we're going to see in just a second, has shown rents are rising, not just My Housing Market showing higher rents for units, but also the ABS has now had a couple of months in a row of higher rents coming through. We'll talk about that shortly. So, a little bit of a mixed message there in the first statement. And then, of course, put it all together, the Reserve Bank said there are uncertainties about the outlook for domestic economic activity and inflation. Okay, admit it, you don't know. And the extent to which monetary policy remains restrictive. Well, has it ever been restrictive? I mean, we've had a booming housing market. We've had, a very strong labour market. We've had very strong retail sales data. Tell me that high interest rates have been restrictive. I mean, they're just looking at the sort of historical number and saying, well, if they're this high historically, it means they're restrictive. But it hasn't been restrictive, Rachael. So, it's kept things ticking over. And now they're saying that there's a little bit of uncertainty about whether monetary policy remains restrictive. Of course, it's not restrictive. But anyway, at least they're admitting that, okay, it might not be restrictive anymore. The recent data suggests that the risks to inflation may be tilted to the upside. So now they're saying, well, the risks are now for higher inflation. Oh, right. But it will take a little longer to assess the persistence of inflationary pressures. Well, how long's a little longer? So to me, this is like, really, what are you saying here? Is it black? Is it white? Is it whatever? Left? Is it right? I'm just not sure here. And let's face it, neither are they. But look, as I said, I think that the outcome for that, notwithstanding anything that might come from left field, is that things will be on hold for a while. And look, at the end of the day, hindsight's 2020, of course, but I think that we've had maybe one, maybe even two interest rate cuts that really don't reflect the data that we've had and the outlook that the Reserve Bank was telling us a few months ago. So let's enjoy that. We've certainly had very strong prices growth. People always embrace lower interest rates, more money in your pocket with a lower mortgage rate, and higher prices for your house, which helps your wealth effect. So tick all those boxes and just say, okay, well, it's good that we've got a couple brought forward maybe, and we'll take that and we'll take the money and run, if you understand what I mean, Rachael. So there's our chart. Interest rates down and down and down in the cycle until we got to the COVID emergency measures where official interest rates were just above zero. And then, of course, the Reserve Bank increased interest rates because inflation went through the roof because of those, because of the stimulus packages that we introduced to offset the problems with COVID and lockdown. And then beginning last February, we got an interest rate cut because the Reserve Bank had said that they were happy with what was happening with inflation. Yes, pregnant pause. And then we had another cut in May and followed up in August. So, and now I think we're in for a period of flat interest rates, notwithstanding anything that can happen. And I think even as inflation rises in the shorter term, which is likely given what's going to happen to electricity prices post-subsidy, I don't think there's any value in speculating about higher interest rates, as many will, because it's obviously a pretty solid attention seeker going forward. So that's our story, Rachael, on the latest decision from the Reserve Bank, and we won't have another one till February.
Yeah, well, we expected that they would hold, so it's still rates at 3.6 for the fourth month straight. So no surprises, as you said, but it's a very tough conversation. This whole topic is tough because, as you said, the statement hints at temporary inflation factors and uncertainty around the CPI data. And there's some weird things being said there. But what should buyers and sellers actually take from this, and what should we be looking at in 2026? Because we can't just keep throwing the subsidies at it.
No, that's right. And because the problem is then that means, look, it means, okay, that's great in the shorter term, but two factors happen. Firstly, the subsidy's got to come off unless we're just permanently using taxpayers' monies to pay electricity bills, right? Okay, I'm not sure that's sustainable economically. And the other thing is that even if we did that and continue to subsidise electricity, we're still not seeing the real benefits from the switch from renewables, from the carbon economy to renewables. So we're still going to see prices rise irrespective of the subsidy. And we can't just keep increasing the subsidy, or perhaps we'll go broke because we won't have enough money to cover that, because everybody's using electricity, and it's not just households, it's also obviously businesses such as coffee shops, that are doing that. So, but I think the outlook for answer your question is actually reasonably positive because, I think we'll see flat interest rates for a while now. As I said, that takes a bit of volatility out of the market. We've had massive rises in house prices this year, or certainly very strong in house prices this year in most capital cities, and unit prices, depending where they were on their sort of individual cycles. That'll taper off because, you just can't keep pumping up home prices, going to the bank and asking for another 100 grand or 200 grand if you don't have a lower interest rate or a higher income. So that virtually starts to steady house price growth, which will still be positive because we've got, other policies coming through, such as, the government's, number of packages for first home buyers and low income buyers, So that'll mean, sort of more demand anyway. But the nature of being able to push prices up higher is constrained by, the bank's strict lending policies, which is a really good thing. So what I'm saying is that's good for certainty, because it's not going to create the volatility in our markets, and we'll get some certainty. But of course, what will happen is if we do start to see a peaking of the price cycle, which is just normal as we move past the volatility of either lower rates or higher incomes, you'll get the scary campaigns about, see, house prices are falling. No, they're just not rising as fast as they were when you had 3 interest rate cuts in 6 months. but that's another story, and it'll be picked up by the media. So you just got to hold your nerve in a sense and realise that it's been a big gain in most capital city housing markets over 2025, which will consolidate in 2026. So we'll see what happens. All right, so let's move on. We've had lots of talking about interest rates and quickly go through the latest home rent data. And this is the My Housing Market report for November, home rents, units and houses. We saw across the board increases in unit rents, Rachael. Houses, however, steady over November. And we sort of saw a little bit of easing in vacancy rates, a little bit higher for both houses and units, but still very low. So it was just a bit of a sort of a marginal adjustment from what was a steep fall in October due to a rush in demand. Let's look at the numbers now. Sydney, the most expensive as usual for house rents at $800 per week for asking rents, and Hobart the most affordable at $589 per week. Over the year, still some very solid results there, with the exception of Melbourne, where house rents have fallen by 3.3%, which is a little counterintuitive because their vacancy rate is still quite low at 1.4%. But over the month, most of the capital city markets were either flat or up just marginally, with the exception of Darwin, volatile Darwin, down by 3.6% and Hobart down 1.3%. But vacancy rates, Rachael, for houses are still very low, most well below 2%, which is sort of the balance mark for vacancy rates between higher and lower rents, and a number there below 1%. So this is still reflecting a shortage of stock, listed stock for house rentals. And even though there's a slight uptick in the monthly change in vacancy rates, they still remain quite low. And I think we'll discuss the units now, because that's quite interesting, because we did see a surge in unit rents over the month. We haven't really seen this sort of a breakout for a while. And I think this is maybe units are typically the more affordable option in the rental market. And I think that maybe there's a gravitation towards units now because they're more affordable as part of that now new adjustment process from still very short numbers or low numbers of properties that are available for rent. Sydney, as with houses, still the most expensive capital city to rent, and Darwin the most affordable there at $463. A stronger growth, as you would expect, over the year for units. Top performer there, Adelaide up 11.1%, but these are good, strong results for unit owners in terms of rental increases over the year. Just remember, they've put on top of that what has been a very strong year for most capital cities in terms of capital growth for units. So your return and your return on investment in terms of the growth in rents, and of course your higher prices, is good news for investors out there. Rachael sort of ticks all the boxes. Vacancy rates a little bit higher for units as usual than compared to houses, but vacancy rates, interestingly, for Melbourne and Canberra, vacancy rates are over 2%. But we did see an increase in Melbourne rents of 0.8% over the month and up by 5.3% over the year. So Melbourne's certainly on the road to recovery, not just in terms of prices, but also rents. And I would expect this to continue. Obviously, we're getting the shutdown period, which is for a couple of months. People are distracted. There's not as much demand coming through, and we await February, March for the market to pick up again. But certainly we're ending the year in terms of asking rents in the same vein as the ABS has been telling us for the last couple of months, because they've been telling us that rents, and that's total rents, not just asking rents, but also rents from existing tenancies, have been on the rise now for a couple of months. So we're sort of correlating that, but we have said that consistently with these low vacancy rates for both houses and units, you can expect to see higher rents eventually. And now that's what's occurring. If you want to get a copy of that latest rent report, My Housing Market November rent report, there's a QR code. You can scan that and it'll give you a PDF copy of the report, Rachael.
Yeah, look, I think we're seeing a lot of our renters being pushed into units more out of necessity because of the smaller price point. But you're looking at some of that data in some of those capital cities, the unit rent price point is almost as much as the houses.
Yes.
Are we starting to see a genuine preference change now?
Well, I think that's likely over the longer term, Rachel, because that we're seeing a shift towards unit living. And of course, the first argument in favour of that is affordability, because if you buy a unit, it's typically cheaper than a house, and if you rent a unit, similarly, it's typically cheaper than renting. Sorry, if you rent a unit, it's typically cheaper than renting a house. And there's also lifestyle preferences that are happening here as well. Closer to the CBD, closer to established infrastructure, smaller footprint, maybe cheaper electricity prices in terms of a unit versus a house. And that's all part of the bigger picture. We've seen a surge in unit development this year, particularly in Melbourne and Sydney. They're trying to catch up with their undersupply environment. And that undersupply is also part of the equation, because there just aren't as many properties around. That gives us those low vacancy rates. And what we're seeing now certainly is higher rents, and it'll be interesting to see if that consolidates next year. And of course, we now look at the latest weekly auction results. Of course, we've got really one real week left in the auction market, Rachel, probably two, because one of the trends we've seen over recent years is people having properties, happy to have their properties in the market just the week before Christmas. But certainly we've seen clear signs that the market's just starting to ease, and we expect that into December, the first full week of December auction activity. Auction numbers and clearance rates predictably ease, because people are thinking of other things, and they've done their buying and selling. It's been a big year for buying and selling. In fact, a record year for the number of sales. I think my preliminary data is telling me that we might see a record spring in terms of the number of properties actually transacted. So that shows you how strong the market's been, Rachel, even irrespective of prices growth. And of course, the same old for the next 2 weeks until we do get to Christmas. We'll see an easing in numbers and likely an easing in clearance rates, but we await to see that data when we bring our final show next week. So Sydney, half the auctions over the past week compared to the previous week. Clearance rate still pretty good there in favour of sellers, 66.8% and higher than where it was a year ago. Listing numbers lower, it's considerably lower than where they were a year ago in Sydney, Rachael. Melbourne actually held up. It was, it was the outlier in terms of auction numbers, similar to the week before. Big numbers, 1,560 auctions in Melbourne. That's a high number for December, let me tell you. In fact, I think that might be a record number for December auctions in Melbourne. Still a reasonable clearance rate, 66.1%. Of course, these Sydney and Melbourne down a little bit compared to the previous week. Still ahead of where it was a year ago, but listings higher than where it was a year ago in Melbourne. Brisbane, Adelaide and Canberra, listings all down, and clearance rates also a little bit down, but tracking still higher than where they were a year ago, with the exception of Canberra and Adelaide. But it's just clearly what we see at the end of the year, Rachael, easing in auction numbers and a slight easing in clearance rates, and that data is notwithstanding the cycle. And when we look at the monthly clearance rate data, we can see that easing over spring is what we see as more properties come into the market. But clearance rates still track basically at 70% plus in Sydney, and a really strong spring for the Melbourne market. Really since those interest rate cuts, has been tracking well above 70% for its best results in about 3 years. Brisbane down a little bit as the spring selling season concludes and we get towards the end of the year. Adelaide also easing, as with Canberra. So seasonal effects there affecting, as expected, our results in the weekly auction market. So if you want to get hold of those latest auction results, Rachael, you can get which is very good for insights into general housing market activity. That's why we bring them to you every week. It's like reading the tea leaves, and it's always reliable. So the weekly Capital City Snapshot released on my LinkedIn channel, which is Doc Andrew Wilson at LinkedIn, every Saturday night around about 6 o'clock. And the full national report is released Sundays at around 9 o'clock, which includes the regional breakdowns for Melbourne and Sydney, which is good because it gives you insights if you're in Melbourne and Sydney as to how your local region is performing in the auction markets. And again, a very good insight generally into how the market in those regions is performing. And if you did miss the latest full national report, there it is there. Get a QR code copy of that, and we'll give you a PDF file for the latest national report. As usual, we'll quickly finish off with the greatest giveaway in housing, Rachel, the My Housing Market Infinity suburb app, which gives you the latest asking prices and rents on every suburb in Australia that has data. Wow. Click the hot link there or get a copy of the QR code. Go to the good folks at Infinity. They'll tell you how to access that app, which is great if you want to know what's happening on a suburb basis. Here's a screenshot of the app. We're looking here at prices. You can also look at rents. You can filter it for capital city regions or outside capital city regions. We're looking at New South Wales, Sydney region. We've picked Blacktown as a suburb. You can filter it for house unit or townhouse. We're looking here at houses, and you can also filter it for the number of bedrooms, Rachel. So you can really drill down to find out exactly what's happening in the market at a granular level. So 4-bedroom house in Blacktown, not just the median asking price, so telling you what the agents and vendors are asking for their properties at the moment, but also the low and the high. So you have the boundaries between the market there, so you can get a good feeling for what the market is holding at the moment, and also the number of properties for sale, which is 20 there for Blacktown. Exactly the same thing there for the rental market. So good news there for analytics for either tenants or landlords or anybody who's just interested in what's happening in the rental market. We also have something for investors on the app, which is the top 10 yields on each of those regional breakdowns. Here we're looking at New South Wales, Sydney region, 1-bedroom units, and this gives you the top 10 yields. So that's a return on investment, which looks at gross yields. So it doesn't include your particular expenses, but it's about the aggregated asking rent currently divided into over a year, divided into the current asking price. So that gives you your return on investment, your gross yield. And you can see there the top 10, not only the yields, but also the current vacancy rate, the number of properties for rent, and the number of properties for sale. So it's quite a comprehensive insight into that suburb-based investor market. And those hot links will give you a map of the suburbs, just in case you don't know where they are. You'll be able to have a wonderful little journey through Sydney suburbs or the other capitals or regional suburbs to tell you where these high yields are exactly. Next week, November labour market, it will be our swan song. See you later, alligator. See you later, 2025, and we'll be back in 2026 for more. And actually, we're going to have a big change in our app next year, Rachel, with latest news. So look forward to that. That'll go off the shelf like hotcakes. So we'll look at the November labour market, important data there in terms of interest rates. November regional house prices. I want to get the regional house prices in before the end of the year for those that are outside the capital cities. And we'll also look at October house building costs if we have time. And finally, the latest weekly auction results, which will likely be the last week of significant auction activity. So it's been another great week, Rachael. Thank you very much for your insights. There is a QR code if you've missed any of this today. You can scan that and get a PDF copy of our report. So until next week, Rachael, via con Dios, and then we'll say our final goodbyes for 2025. But what a year it's been, certainly. It's been a really big year, and look forward to next year, because we'll be able to tell everybody exactly how strong 2025 has been when we have the end of year results in terms of house prices. My voice is just about gone, but I made it.
Yeah, well, Doc, you're a man of many talents. I don't know what you just said to me before, but I believe it said adios, I guess.
Via con Dios, I think that means go with God, but
there you go, I like that.
So for all our Spanish speakers out there, via con Dios, or hasta la vista, I don't know, but that's about all my Spanish anyway. But you got to keep it light, or people say, "Oh my God, that guy's so boring." But anyway, it will be great next week to do it all again for the last time in 2025, and it's been great having you there. But we'll talk about that next week, shall we not, Rachael? Go out and do some Christmas shopping, girl. Gee whiz.
No, I'm so behind. Definitely looking forward to that regional house price data. I know a lot of our listeners like to get that, because we do focus on the capital cities a lot. So that does wrap up another week of unpacking the numbers and the data that shapes the nation. A big thank you to Doc for guiding us through it. And we will be back next week with more data, more insights, and more direction for buyers and sellers. Thank you so much for listening.
Thank you, Rachael.